Hello everyone. Let's discuss chapter 3, that is Goodwill, Nature and Valuation. Learning objectives. In this chapter we will going to learn meaning and nature, features, need for valuation, factors and methods. Now what do you mean by goodwill? Goodwill is a value of good name or reputation enjoyed by a firm that enables it to earn over and above the normal profits. It is an intangible asset. Intangible asset means which cannot be seen and touched. It can only be felt. Let's discuss some famous brands, that is Adidas, McDonald's, Apple. How goodwill comes into existence? It may be due to locational advantage, brand value, patents, customer loyalty, trademarks and market reputation. Now from partnership point of view, what do you mean by goodwill? Goodwill is the amount paid in excess to purchase consideration. Let's discuss one example, Company A and Company B. Company A wants to purchase the business of Company B. Company's assets are of rupees 20 lakhs and liabilities 12 lakh. We will have to calculate net asset value, that is assets minus liabilities. That is 20 lakh minus 12 lakh, that is 8 lakh. Now purchase consideration minus net assets, that is goodwill. 10 lakh minus 8 lakh is 2 lakh. Now the value of goodwill is 2 lakh. Now discuss the nature of goodwill. According to AS 26, there are two types of goodwill, that is purchase goodwill and self-generated goodwill. Purchase goodwill means the goodwill for which the consideration has been paid, recognized in the books of accounts, means we have to show this in the balance sheet. Self-generated goodwill. Self-generated goodwill is a goodwill that has been generated by the business because of which it is able to earn higher profits, not recognized in the books of accounts, that is need not to be shared self-generated goodwill in balance sheet. Features of goodwill. First is intangible asset. Intangible means it cannot be seen or touched, it can be felt only. Then AS26, that is goodwill has no separate existence from its business. Value of the share of profit sacrificed, that is at the time of admission the existing partners sacrifice their share of profit for the composition of goodwill. Helps in earning profit. Subjective means it is the estimated value. And attractive force means attract the customers. Now why there is a need to evaluate goodwill? First is change in profit sharing ratio between the partners. Then on the admission of a new partner, on retirement or death of a partner, or amalgamation, that is when two companies amalgamate, and when the firm is sold, that is partnership firm is sold, and when firm converted to a company. Now let's discuss factors. First is period, that is how long the business is going on. Then there is location. Location means business is located at a prominent place, easily approachable by the customers. It will earn good profit and that will raise the value of goodwill. Then there is management. Efficiency of management. If the management is efficient, the firm will earn good profits and that will raise the value of goodwill. Then there is quality. Quality of the product enjoys good reputation for the quality of the product and there will be ready sale and value of goodwill increases. Then there is contract. Sometimes the firm enters into long-term contracts for sale and purchase of the goods at favorable prices and this will increase the firm's profits and goodwill. Then there is market situation. If the firm enjoys monopoly market or limited competition, it will earn high profits and results in increase in value of goodwill. Now discuss the methods. There are three major methods, that is average profit method, super profit method and capitalization method. Now discuss average profit method. There are two types, First is simple average profit and the second is weighted average profit. Now first of all we have to calculate normal profit, then calculate average profit. Average profit is total net profit divided by number of years. Then goodwill is average profit into number of years purchased. Then how we calculate normal profit? In this we have in the question abnormal losses or abnormal gains. Fine, so we have to make adjustments. So if there is abnormal losses or expenses, we have to add, and if there is abnormal incomes and gains, then we have to deduct it, and if there is normal business expenditure, then we have to deduct it to calculate normal profit. Fine, let's discuss the question. Calculate the goodwill of the firm on 2 years purchase or 4 years average profit. Profits were for 2017 12,000, for 2018 18,000, for 2019 4,000, that is loss, and for 2020 14,000. Now in the first column we have to take the years, that is 2017 18 19 20. Then profit, that is 12,000, 18,000, 4,000 loss, and 14,000 for profit. Then we have to add these 4 items. The loss will be deducted and the total will be 40,000, that is total normal profit. Then average profit is total normal profit divided by number of years. Then how many years are there? 1 2 3 and 4, so we will divide it by 4. 40,000 divided by 4, that is 10,000. Then goodwill is average profit into number of years purchased, that is 10,000 into 2. 2 is given in the question, so the value of the goodwill will be 20,000 rupees. Now let's one more question. In this question we have abnormal items, that is abnormal gain and abnormal loss. Calculate value of the goodwill at 3 years purchase of the average normal profit of last 4 years profit were for 2017 90,000, for 2018 1,60,000, for 2019 1,80,000, for 2020 2,20,000. Additional information: an asset was sold at a gain of rupees 10,000 in 2017. Now this is a normal gain. Asset is not sold daily. Fine. So this amount is to be deducted to calculate normal profit. Second is a machine got destroyed in an accident and rupees 30,000 was written off as loss in P&L account in 2018. This amount will be added because this is a normal loss, abnormal loss, so it would be deducted. Then during the year 2019 the firm's assets were not insured and insurance premium being 10,000, it is regular expense incurred every year, so we will have to deduct this expense. Fine, so this is because why? Because this is recurring in nature. In first column we will take the years, that is 2017 18 19 and 20. Then there is profit 90,000, 1,60,000, 1,80,000 and 2,20,000. So first, that is sale of fixed asset, is we will deduct this. Then 90,000 minus 10,000, we will get 80,000. Then abnormal loss, we will add on this 1,60,000 plus 30,000, that is 1,90,000. Then expenditure, that is insurance premium, we will deduct this 1,80,000 minus 10,000, that is 1,70,000. Then again 2,20,000 and add these 4 items and we will get 6,60,000. Next step is average profit, that is total normal profit divided by number of years. How many years are there? 1 2 3 and 4. 4 years, and total normal profit is 6,60,000. So what will be the average profit? That is 1,65,000. Then goodwill is average profit into number of years purchased, that is 1,65,000 into 3, that is 4,95,000. Fine. Now come to the next method, that is weighted average method, weighted average profit method. First of all, assign the weights to the net profit. Then weighted normal profit is weights into net normal profit. Then calculate weighted average profit, that is weighted normal profit divided by total of weights. Goodwill is weighted average profit into number of years purchased. Let's discuss one example. Profit of the year for the last 5 years were: for 2016 is 40,000, for 2017 it's 48,000, for 18 it's 60,000, 2019 it's 50,000, for 2020 it's 36,000. Calculate value of goodwill on the basis of 3 years purchase of the weighted average profit after assigning the weights, that is 1, 2, 3 and 4 respectively, to the profits for the year ended 31st March 2016, 17, 18, 19 and 20. Now in first column we have year 2016, 17, 18, 19 and 20. Then there is profit. which is given in the question: 40,000, 48,000, 60,000, 50,000 and 36,000. Then weights also given in the question, that is 1, 2, 3 and 4, 5 respectively from 2016 to 2020. Now weighted profit. Weighted profit is calculate profit into weight. That is 40,000 into 1 is 40,000, 48,000 into 2 is 96,000, 60,000 into 3 is 1,80,000, 50,000 into 4 is 2 lakh and 36,000 into 5 is 1,80,000. Now total the weight column, that is 1 plus 2 plus 3 plus 4 plus 5 is 15, and weighted profit 40,000 plus 96,000 plus 1,80,000 plus 2 lakh plus 1,80,000. So we will get 6,96,000. The weighted average profit. Weighted average profit, total of the weighted profit divided by total of weights. That is 6,96,000 divided by 15, that is 46,400. Now goodwill, weighted average profit into number of years purchased, that is 46,403 is given in the question. Multiply by 3, that is 3,39,200. Next method is super profit method. First of all, calculate average normal profit, calculate capital employed, that is assets minus liabilities or net assets. Then calculate normal profit, that is capital employed into normal rate of return by 100. Now calculate super profit, that is average profit minus normal profit. Now calculate goodwill, that is super profit into normal number of years purchased. Let's discuss one question, that is a firm earned net profit during the last 3 years as for 2017 it's 18,000, for 2018 it's 20,000, 2019 is 22,000. The capital investment of the firm is 60,000 rupees. Normal rate of return on the capital is 10%. Calculate the value of the goodwill on the basis of 3 years purchase of the average super profit for the last 3 years. Now, total profit, that is we have to add on 3 years profit, that is 18,000, 20,000 and 22,000. We will get 60,000. Then average profit is total net profit, normal profit divided by number of years. 60,000 divided by 3, that is 20,000. Now normal profit is capital investment into rate of return, that is 60,000 into 10%, we will get 6,000. Now super profit is average profit minus normal profit, that is 20,000 minus 6,000 is 14,000. Now goodwill is super profit into number of years purchased, that is 14,000 into 3 is 42,000. Now calculation of average profit. Capitalization method. In capitalization method we have two types, capitalization of average profit and capitalization of super profit. Now capitalization of average profit. First of all we will have to calculate average normal profit, then calculate capitalized value of the firm, then average profit into 100 divided by normal rate of return. In this way we can calculate capitalized value of the firm. Then calculate the value of the net assets, that is all assets excluding goodwill, non-trade investments and fictitious assets minus outside liabilities. Then we will get goodwill, that is capitalized value of the firm minus net assets. Let's discuss one question. A firm earned rupees 60,000 as profit and normal rate of return being 10%. Assets of the firm are 7,20,000 excluding goodwill and liabilities are 2,40,000 rupees. Find the value of the goodwill by capitalization of average profit method. Now first of all, average profit is given in the question, that is 60,000. Total capitalized value of the firm is average profit into 100 by normal rate of return. This is capitalization value. To capitalize the value of average profit, that is average profit into 100 by normal rate of return, that is 60,000 into 100 by 10, that is 6 lakh. Net assets, capital employed. Net asset means capital employed, that is equal to total assets minus liabilities, that is 7,20,000 minus 2,40,000 is 4,80,000. Now goodwill, capitalized value of the firm minus net assets, that is 6 lakh minus 4,80,000. Total capitalized value we have calculated here, that is 6 lakh and net asset is 4,80,000. Now take the difference of these two, we will get goodwill, that is 1,20,000. Now the next is capitalization of super profit. In this method is simple. You have to calculate super profit, then capitalize it that is super profit into 100 by normal rate of return. Then we will get the value of goodwill. First of all, we have to calculate capital employed, that is net assets. There are two methods, asset approach and liability approach. In asset approach, all the assets excluding goodwill, non-trade investments and fictitious assets minus outside liabilities. Then liability approach, capital plus reserves minus goodwill minus fictitious assets minus non-trade investments. Then calculate normal profit on capital employed, that is capital employed into normal rate of return by 100. Calculate average profit of the past year. Then calculate super profit, that is average profit minus normal profit. Then we will have to calculate goodwill, that is super profit into 100 by normal rate of return. Let's discuss this question. Average profit of the firm is 1,50,000, total tangible asset in the firm is 14 lakh and outside liability is 4 lakh. If we take the difference 14 lakh and 4 lakh, we will get 10,000. 10,000 is the capital employed. In the same type of the business, the normal rate of return is 10% of the capital employed. Calculate the value of the goodwill by the capitalization of super profit method. Now, step 1, we will calculate capital employed, that is tangible assets, total tangible assets minus outside liabilities, that is 14 lakh minus 4 lakh, that is 10 lakh. Then step 2, normal profit. Capital employed into normal rate of return into divided by 100, that is 10 lakh into 100 into 10 by 100. 10 lakh into 10 by 100. We will get 1 lakh. Then super profit, that is average profit minus normal profit, that is 1,50,000 minus 1 lakh. Fine. That is 50,000. Then step 4, that is goodwill. Super profit into 100 by normal rate of return. 50,000 into 100 by 10. Then we will get the amount of goodwill, that is 5 lakh. Thank you.